what we're going to do, we're going to go over really, there's technically five different types of health insurance. We're going to go over the 3 to 4 that you guys really need to focus on, what they can be paired with, who they're good for, who they're not good for, and the pros and cons. Okay. So we're going to keep it super clean, super tight. We don't need to go a long time. But we find that it's really helpful to go over these because, it's confusing. It's like drinking from a fire hose when you get started. You just don't know where to go. You don't know what everything is. So we're going to start from the top as we work through these series. Next week, what we're going to do, I'm going to run through exactly how I do a presentation, start to finish, how I share my screen, what I go over for that. So Till, can we see my screen? Are we sharing my screen?
You can. If you hit slideshow, it'll show up larger.
Well, okay. See, that's why Matilda's here. Okay, cool. So the 4 different types, guys. So there is, actually, let me go back here. Oh God. Just do it here. So 4 different types of health insurance. You guys have probably seen this slide. If not, it's good to recreate. So there's ACA, Obamacare, Marketplace, all the same thing. Short-term medical, health share ministry, and indemnity and defined benefit with specified disease. I would almost throw America's Choice as a 5th option for ACA clone because it doesn't really work like the rest of them and it doesn't fall under ACA. So you could add that as a 5th option for ACA clone. Okay. So we'll start with ACA. Now, honestly, if you're in your first year to a year and a half, even 2 years, you probably don't need to worry about ACA. It takes 4 to 5, sometimes 6 hours to get your FFM certification done. And then when you close a deal, you make about $17 to $20 a month per person that's on that. Eventually, does it make sense? Yes, it does make sense to get that so you can offer more of a variety. But in your first year to 2 years, just don't worry about it unless your manager tells you to. Refer it to the house, refer it to us. For all of our agents, if you refer it to us, we do have like a referral fee associated with that. Same thing with USABG HQ. If you refer it to them, they give you a referral fee, so you make a little bit. But with ACA, who this is good for, it's good for low income and people who have major pre-existing conditions, okay? So there is a form or a paper out there where you can track what income is based on their household size. Honestly, if you just go to Health Sherpa, plug in their information, you can see that more than likely for the people that we're working with, it's not going to be affordable and it's not going to make sense, okay? But for the people that does, maybe it's a young couple and they only make $30,000 to $40,000 a year. Typically, it's a family, mom, dad, a couple kids. They don't have a high income. They qualify for a subsidy on ACA. It's typically a really good option for them. People with major pre-existing conditions, cancer, heart attack, stroke, insulin-dependent diabetes, this is going to be the only spot for them because it's the only one that's going to cover those major pre-existing conditions. And typically there's some copays associated with those. Like if someone has diabetes, that's going to be tens of thousands of dollars a year, typically in treatment. That they'll hit their deductible, they'll hit their max out of pocket, and then the insurance will take care of the rest for them. Okay. The private sector plans are not going to accept them. So who this not is a good fit for? High income individuals, typically business owners. And when I say high income, everybody has a different perspective of that. Typically it's above 80,000. If they make over $80,000 a year and they're a single, a couple, or even a small family, this typically is not going to be a good fit for them. We had a couple, I think it was last week, it was a family of 4. They were in their 40s and the lowest plan possible was $1,500 a month with a $7,500 max out of pocket before anything is covered. It's just not a viable option for them. So that high income typically falls within those business owners, which is, I would say 98% of our clientele is going to be self-employed business owners. And then obviously healthier individuals. So if they're young, they're healthy, they don't go to the doctor all that often, this might not be the best plan for them because they're going to be paying their premium out of pocket. And then they're also typically going to have to pay out of pocket for their services because they have a deductible to meet. Okay. So if we go to the next one, again, we've already gone over this, but pros and cons. It will cover pre-existing conditions and it does have a maximum out of pocket. That is a big pro to ACA. There is a defined max out of pocket that you're going to pay with no limitations on what it will cover, right? like the specified disease, we'll go over that. Sometimes if it falls out of that specified disease, that might leave a gap. We have plans to cover that. But that is a big benefit to this one, okay? And if they qualify for a subsidy or a tax credit, that's where that low cost comes in, right? They're a young couple, they make $30,000 a year, they qualify for an $800 a month tax credit. Their plan is $25 a month. You're not going to be able to beat that more than often in that scenario, okay? Couple of the cons, it's a high deductible to meet for services, right? Hospital, emergency room, surgeries. For most plans, you're going to have to come out of pocket at least $7,500. And then there's a copay of typically 30 to 50% until you've reached your max out of pocket of $9,200. Most surgeries, if you go outpatient, are going to cost, again, depending on what you get done, $5,000 to $7,000. So you're going to be paying your premium and you're going to be paying out of pocket for most of your services. One big downfall to this for our business owners, because their income is variable, it's hard to predict what your income is going to be at the end of the year. So let's say someone says, typically, we make around $50,000 a year. That's what we made last year and the year before. This year, if they have a good year and make $80,000, they're going to get a tax bill at tax time because they technically didn't qualify for that subsidy that they were paying for. So they're going to get a tax bill when that comes. Now, we had one guy, he came to us after this happened. He wasn't our client at the time. He came to us because he got a $14,000 tax bill because his income was wrong. So that has to be accurate and you have to make sure they know that. If you start to project that you're making a lot more than we anticipated, we have to update that in the middle of the year, okay? Another con with this, plans tend to change year to year. If you sign up for one plan this year, it's probably not going to be offered the next year. And the premiums increase consistently with these plans because it takes everybody. So they're paying out a lot of claims because it's taking the unhealthy people, the people with pre-existing conditions. So these will trend upward at a faster rate than the private plans, okay? But what we can do is if people have the budget, typically if they're on an ACA plan, they don't have a huge budget. Sometimes you can get someone who's pretty good with their money, they qualify for a subsidy and they have a little bit of a budget to help, okay? Couple things this can be paired with. Indemnity, which we're gonna go over. This is really good because the indemnities, Manhattan doesn't have any deductibles or copays. PAL doesn't have any copays. It does have a confinement deductible. We'll go over that later. This is a really good option because say they have, a $7,500 deductible on their ACA plan and they need a surgery. What we can do is we can run that surgery through the ACA plan, take those bills and submit it to the indemnity plan, and they will reimburse that client whatever the amount is they cover for that surgery. It could be a portion of it. It could be all of it. It could be above and beyond, okay? We had a client last year. They were on an Ambetter plan. They were diagnosed with a heart condition. They needed stents put in. Put them on an Ambetter plan. They paid their $9,200 max out of pocket. We submitted to Philadelphia American. They got a $27,000 check back. So they were in the green about 18 grand by pairing those two plans together. Okay. Another good option is an accident plan. So GAC is a really good accident plan, straightforward, anywhere from $2,000 per incident up to $25,000 per incident. Manhattan also has a good one. PAL also has a good one. This is good for the deductible and max out of pocket. Okay. A lot of times if you're in the emergency room, it's probably due to an accident. So if, they have a young family, they have boys tend to get hurt a little bit easier than girls do. He goes in for a broken arm, they have to meet their deductible and it was an accident, but you've got them on a $10,000 GAC accident plan. We take that, submit it to GAC. GAC will either pay it directly to the hospital, depending on how you want to cover it, or if you just paid your deductible, they'll reimburse you directly for that amount, okay? So we're covering the gaps with these plans that we're going to pair for it. Critical illness, another good one. This one honestly is a really cheap option to add. It's a very good, inexpensive add-on. What a critical illness does is it's a lump sum payout. PAL's got a really good one for critical illness. Typically, you're going to range anywhere from $10,000 to $30,000 for this. They do have, I think, a $50,000 and maybe a $70,000 one, but there's a little bit of extra underwriting attached to it. So we'll typically put folks on a $30,000 one. So if they walk in and they're diagnosed with a critical illness, which is typically cancer, heart attack, stroke, diabetes, something along those lines, as long as it falls under that critical illness, the company is going to cut that client a check directly to them. Okay. Again, further protecting them from their deductible and max out of pocket. Okay. Again, if you guys have questions, write them down. We'll come back after we go through all of these. The second option, and honestly, probably the most popular option that you guys are going to write, is indemnity and specified disease. Again, this training, we're going to go over what they are, what's good to pair with them, and we're going to do future trainings on the details of each plan that you can write. Okay. This one, pretty much the exact opposite of ACA on who it's good for. It's good for business owners, it's good for high income, and it's good for healthy people. This has absolutely nothing to do with your income as far as premium goes. It's the zip code that you live in, the age you are, and the coverage that you want, and the size of your family, obviously. Who it's not good for, typically low income, right? If they have a low income, we're going to want to put them on the ACA because they have a subsidy. They're probably not going to be able to afford the premiums of indemnity and specified disease. Also not good for pre-existing. Now this pre-existing, it depends on the company. They're pretty loose with this. What they're looking for is like insulin dependent diabetes, cancer, heart attack, stroke. They're okay with like high blood pressure, high cholesterol. You just have to let them know there is a pre-existing clause. So if anything were to happen related to those, there's a chance that stuff's not going to be covered, but they're pretty lenient. They're looking for the major things, not anything, day to day. Okay. Metformin, they'll take metformin. They're just looking for insulin dependent diabetes. Okay. Pros and cons to indemnity and specified disease. One, you always want to write them together. Okay. If you're writing PAL, you always want to do a PAL, HSP Gold or an Optimum with either a PAL specified disease plan or a medical mutual specified disease plan. You never want to write indemnities independent of an ACA or a specified disease. You have to have that on the back end for coverage. Okay. Pros, first dollar coverage. There's no copays, and depending on if you do Manhattan or PAL, there's no deductible to meet. Okay. So those healthier individuals, when they go to see a doctor, they go to a medical facility, they're going to have upfront coverage for those. Okay. For Manhattan paired with medical mutual, you only have to hit the deductible, and PAL too. You only have to hit the deductible if it's a major event. All right. If you're hospitalized, if you have cancer, heart attack, stroke, end stage renal failure, organ transplant, that's the only time you have to hit a deductible on these plans. Okay. These plans are underwritten, meaning they keep, quote unquote, the unhealthy people off the plans, which enables them, one, to pay out first dollar benefits, and two, keep the rates stable because they're less likely to pay out bigger claims than the ACA plans are. Okay. Open access PPOs. You can go wherever you want in the country. Manhattan, PAL, Medical Mutual, they're going to follow you no matter where you're at. There's no limitations on counties or states. If they participate with the First Health Network, fantastic. Most facilities do. You can hand in your card and let them take care of the billing. Typically, we encourage most people to do self-pay in most scenarios because you get a very heavy discount that gives us a little bit of negotiating power because we can see what they're charging and then we can submit for reimbursement. Okay. And that's where that option to self-pay comes in, and the ability to receive excess benefit. I probably spelled that wrong. I spelled the access benefit. Ignore that. No one probably would have caught it if I didn't point it out. But with this, so excess benefit, a good example. If you're on a Manhattan Classic Plus, you have 8 doctor visits covered at $125 per visit. You can use those for the chiropractor. So when we go, we pay $40 for the chiropractor. We self-pay, submit for reimbursement. We get a $125 check back, even though we only paid $40 for that doctor visit. Okay. So you have the ability to, you can't say make money, but you have the ability to receive excess benefit. Okay. As of right now, that excess benefit is non-taxable income. Doesn't mean our government won't figure out how to tax it at some point, but as of right now, it's non-taxable income. Okay. The cons. It does not cover major pre-existing conditions. That's something you have to be aware of. If they've had a major pre-existing condition, It will not cover it if it resurfaces within the first 12 months, or if they're currently going through treatment, they're not going to get approved for pre-existing conditions. It does require someone to be a little bit more consumer minded, meaning you have to pay attention to where you go. If you're someone who just walks in, hand your insurance card, doesn't check anything, this is probably not going to work well for you. And honestly, that person doesn't work well on any insurance plan. We've had people do that. We've all had people do that where they text us. I know Manny's had it. I know Adam's had it. They text us, they're like, hey, I got a surgery last week. You're like, fantastic. I know you didn't call me. So did you call the insurance company? Did you check the network? Did you check anything? No, I just went in. Like, okay, great. We'll figure this out the best that we can. So it is good to encourage that person. You start to figure out what personalities are what. If you feel like this person is not someone who's really consumer minded, ACA or America's Choice, which we're going to go over, is probably better for that person. If this person's savvy, if they're already used to self-paying, if they already like going to the urgent care, this is probably going to be a good option for that person. Another limitation, how many services you can use in a dollar amount limited to that, right? A good example, you have 8 doctor visits on Manhattan Classic Plus, limited at $125 per visit. So there is a chance you come out of pocket a little bit for doctor visits. But again, if you're consumer minded, if you check things before you go, that's not going to happen very often if you pay attention to what you're doing. Okay. But that is a limitation to the plan versus ACA. Okay. Couple things indemnity and specified disease can be paired with. Obviously, accident plans. GAC accident is a great go-to for this because it fills that gap for the specified disease. If they have an accident and they end up in the hospital, the specified disease doesn't fall into that. If it's outside, right, someone breaks their arm, that doesn't fall under the specified disease plan. It'll fall under their accident plan. Critical illness, again, is another great one to put on that. If someone has a medical mutual $5,000 deductible plan and they're diagnosed with cancer, great. If you have a $10,000 to $30,000 critical illness plan, you're going to get paid that out directly. You're going to be able to cover your deductible with that critical illness. Okay. Next one, America's Choice. America's Choice is a really good option for those people who like traditional copay deductible structures, but don't want to pay the price of ACA. Okay. Again, this is good for business owners. This fun fact, you have to be self-employed to participate in this plan. You have to collect some sort of 1099 income to participate on America's Choice. Okay. Same thing for indemnity and specified disease. It's good for higher income people and it's good for healthier individuals. Definitely not good for low income. Pre-existings, you have a little bit of flexibility there. There are a couple of knockout questions that you have to pay attention to. So that one can be pro, it can be con. It kind of goes both ways. It's not as intensive, but there are a couple of knockout questions you have to pay attention to. Pros and cons, again, set copays and deductible. The ones that we use the most are the $1 million max plans. So they have a deductible of $250, $500, or $750, which is very low compared to most ACA plans. Your deductible is typically $7,500 to $9,000. So you pay 100% of that out of pocket, that $250, let's say, and then everything else has a copay attached to it. Your doctor visits are $50. Your emergency room is $250. Your inpatient hospital stay is $1,000 copay. And your surgeries are a $250 copay after your deductible. Okay. Again, limited knockout questions, not as intensive as indemnity or specified disease. A couple of knockout questions you have to pay attention to. The max plan is a part of PHCS PPO. Again, that's essentially a sister network to First Health. Both, if one takes First Health, they'll probably take PHCS and vice versa. And then you do have an option to do the GigaCare plans, which is a part of the Blue Cross Blue Shield network. Some are PPO, some are EPO. This one, you're probably not going to write as much. But if you have that high income person who wants the ACA feel, but doesn't want to go on ACA because their income is variable, it's high, it's whatever, the GigaCare is also a good option to take advantage of. Okay. Some of the cons, again, you do have to collect self-employed income. You cannot be W-2. You have to have some sort of 1099, or if you're an S Corp, and you're an employee of the business, but you own the business, that will also qualify. Another con, the network is important. If you're out of network, it will affect your coverage, okay? Because it works like an ACA plan, you have to make sure your facility is in network, so you have your set copays. If you're outside of that, it could cause a little bit of trouble with the coverage. And con as well, limitations on how many services or dollar amount that you can get for each, okay? On the max plans, at least. The max plans, you have 10 doctor visits per year. The emergency room visit, you have 2 visits per year. The surgeries, you have 3 per year. The hospital stay, I think you have 10 days per stay, and you have up to 2 or 3 stays. So some limitations you have to be aware of and make sure your client is aware of, okay? Some plans we can pair this with, same exact thing, indemnity. Indemnity is a really good option. If they have a good budget, I'm going to do a max plan with a Manhattan Life, because the Manhattan Life doesn't have the confinement deductible for the hospital. If they're in the hospital, they pay their $1,000 copay. If they're on a Classic Plus, they get $2,000 per day that they're in the hospital. So that's already more than covering their hospital stay. They get 8 doctor visits a year, covered at $125 per visit. They have a $50 copay. Great. That's going to cover their copay. So Manhattan Life is a great option to pair with America's Choice if they have the budget for it. Obviously, accident again to help with those copays, deductibles, and critical illness, same exact thing as the other ones. Okay. So this, guys, these are your 3 main choices that you're going to run with.